So, a lot of people are drawn to mutual funds as a first step into investing, but there's a lot they're simply not told about how these things really work. Many new investors start with mutual funds or unit trusts, thinking they're a safe and easy way to grow wealth. But there are hidden pitfalls that could seriously hurt your returns over time. Today, I'll break down key lessons from Money Master the Game by Tony Robbins, so you can make smarter, more informed investment decisions. Let's start with fees, something many investors overlook. Tony Robbins explains that even a small management fee of 1 to 2% per year might not seem like much, but over 30 or 40 years, it can eat up more than half of your total investment gains. Why? Because you're not just losing 2%, you're losing the compound growth that 2% would have earned over time. That's the silent killer of compounding returns. And remember, these fees are charged whether the fund performs well or not. The manager gets paid even if you lose money. Another major concern: most funds don't even beat the market. Robbins cites research showing that over 90% of actively managed funds underperform the S&P 500 over a 10-year period. That means you're often paying higher fees for worse results. The sad reality? Most people don't know that simply investing in a low-cost index fund often does better in the long run. Beyond visible fees, there are hidden costs like trading fees every time the fund buys or sells assets. Marketing fees often bundled into what's called the expense ratio and tax inefficiency, especially if you're in a high turnover fund. These hidden costs can quietly eat away at your returns, and they're rarely discussed up front. There's also something called survivorship bias. Poor performing funds often get shut down, and only the successful ones are reported, giving a false sense of overall performance in the industry. Now, this isn't to say that all mutual funds are bad, but it's really important to read the fund prospectus carefully, understand the total expense ratio, and look for low-cost index funds or ETFs as an alternative. And always ask yourself, are you paying for performance or just marketing? This isn't financial advice, but it is honestly a call for awareness. If this video helped you better understand the risks of mutual funds and unit trusts, please go ahead and share it with someone who's just getting started. And don't forget to like, subscribe, and turn on notifications so we can get this message out to more new investors like you.